Hello everybody, in today's video we will be learning the chapter 5 Stakeholders in Business Organizations of Business and Technology F1 ACC. So before we begin, let's see what are the chapter learning objectives. Define stakeholders, internal, external and connected stakeholders and their impact on organization. Identify main stakeholder groups and objectives of each group. Explain how the different stakeholder groups interact and how their objectives may conflict with one another. Compare the power and influence of various stakeholder groups and how their needs should be accounted for, such as under the Mendelow framework. Before watching this video, please watch the chapter 1 video. After doing the chapter 1, you can come to chapter 5. The playlist is given in the description box below. Stakeholders. Internal stakeholders, connected stakeholders, external stakeholders, and the conflict between the stakeholders. We are going to study about this. What is a stakeholder? A stakeholder is an individual or group who has an interest in what the organization does or who affects or can be affected by the organization's actions. So anybody and everybody who is related to the organization or the firm in a direct way or an indirect way, whoever gets affected by the activities and the steps taken by the organization, they are called as the stakeholders. They have an interest in the organization. Different stakeholders have different views and different stakeholders have different needs which are to be met. Stakeholders are broadly classified into 3 types: internal stakeholder, external stakeholder, and connected stakeholders. To begin with, let us see what internal stakeholders are. These are any stakeholders that are within the organization itself. Their objectives are likely to have a strong influence on how it is run. Internal stakeholders include employees, managers, directors. So, internal stakeholders are the ones which are connected or which are related to the organization itself. They are within the organization and they have a strong influence. So, internal stakeholders are someone who comes to the organization every day. See it that way. Internal stakeholders are those stakeholders who come to the organization every single day. For example, employees. Employees are internal stakeholders because they come to do their jobs every day and they have a strong influence. So, employees. Managers and directors. Managers and directors have a strong influence and they are also very strongly related to the organization and they also have a strong influence. So, internal stakeholders include employees. What are the needs and expectations of employees? What does an employee want? An employee wants a pay, good working conditions, and job security. Example: if the workers or the employees are given more responsibility, then they will obviously expect increased pay. Coming to managers and directors, what do they expect from the firm? They expect a status, a pay, a bonus, and job security. If growth is going to occur, then obviously the managers will want increased profits, leading to increased bonuses. Test your understanding 1. Which of the following statements are correct? Internal stakeholders have little influence over the way an organization is run. This is false because they have strong influence. The needs are and expectations of managers and employees will always tend to be the same as they both are internal stakeholders. We just read that different stakeholders have different needs, so this is also not true. So option C, neither is the answer. Coming to connected stakeholders. Connected stakeholders either invest in or have dealings with the firm. So in internal stakeholders, we saw that they come to the organization every day. Connected stakeholders are those stakeholders who come to the organization sometimes, like they keep coming sometimes. Not every day, but they have dealings with the firm or they come sometimes. So like shareholders, customers, suppliers, finance providers. So do shareholders come every single day to the organization? No. So they're connected. Do customers come every single day? Yes, they do come every single day, but they are not working for the organization. Customers are not working for the organization, so that, however, they do have a fair share of influence. So customers are also connected. Suppliers have dealings with the firms, so suppliers are also connected. Finance providers give money sometimes, but they don't come and sit every day in the office, so even they are connected. Why are employees and managers internal? Because they come every single day. Is that clear? Now we'll just go and see the need and expectations of the shareholders. Shareholders, what do they need? What do they expect? Steady flow of income, possible capital growth, and continuation of the business. Obviously, we want the business to continue. If I have a share in a certain company, I want fair share of income, continuous share of income. I want to have a capital growth as a shareholder, and I would also want the continuation of the business. Example, if capital is required for growth, then the shareholders will expect a rise in the dividend stream. If the shareholder is expected to give more capital, then they will obviously expect more dividends as well. Coming to the customers, satisfaction of customers' needs will be achieved through providing value for money products and services. So, what does the customer need? They need value for money products and services. They need stuff which is worth it. Any attempt, for example, increase the quality and the price may lead to customer dissatisfaction. So, if there's an increase in price or if there's a decrease in quality, then obviously it will lead for customer dissatisfaction. Suppliers want to be paid promptly. If a decision is made to delay the payment to suppliers to ease the cash flow, existing suppliers may cease the supplying of goods. Finance providers, ability to repay the finance including interest, security of investment, the firm's ability to generate cash. The firm's ability to generate cash is what they see. Moving on to the external stakeholders. These stakeholders tend to not have a direct link to the organization but can influence or be influenced by its activities. So we saw that internal stakeholders come to the organization every day. Connected stakeholders come to the organization sometimes. External stakeholders never really come to the organization, but then they are connected to the decisions and they are influenced by the decisions the organization takes, but they don't come every day to the firm. So they do not have a direct link to the organization, but they can be influenced. As with connected stakeholders, they will have very diverse objectives for the organization to take account of. For example, community. So community at a large does not come every day, but they are affected by what the organization is doing. Environmental pressure groups, government, trade unions. Community at a large. The general public can be a stakeholder, especially if their lives are affected by the organization's decisions. Example, local residents' attitude towards out of town shopping centers. So, the community at a large, if there are shopping centers out of town, they wouldn't want to go. So, they are a stakeholder, like whatever idea they have, if they want to go, if they don't want to go, it has an influence. So, community at a large is an external stakeholder. Environmental pressure groups. The organization does not harm the external environment. So, the environmental pressure group just wants that the organization does not pollute the environment. Example, if an airport wants to build a new runway, the pressure groups may stage a sit-in. So, when the airport wants to build a new runway, then to see the situation, they might not be the Environmental groups might not be directly linked to the organization in any way, but then they know that building a runway will include clearing of some forests, or clearing of some vegetation area. So they might stop it. They are influenced by the decision. Government. Company activities are central to the success of the economy, providing jobs and paying taxes. Legislation, example, health and safety must be met by the company. So, development of the economy or the growth of the economy. So, the government regulates the economy of the country. So, company activities are obviously influence on the economy of the country because companies provide jobs. So it is very easy to understand. I don't think there's anything to explain in that. So obviously government is involved because due to the company, if the company is providing jobs, if the company is providing, proper salaries, and the economy of the country also boosts. Actions by companies could break the law, or damage the environment, and governments therefore control what organizations can do. So if the organizations are doing something which is unethical, then the government can always control it. Trade unions. Taking an active part in the decision making process. If a department is to be closed, the union will want to be consulted, and there should be a scheme in place to help employees find alternative employment. So, trade unions. So, trade unions always take a part in the decision making process. So, if there's a department which is to be shut down, then obviously they are going to make sure that the employees get a job somewhere else. So, that is what is external stakeholders. They are not directly connected to the organization. Test your understanding too. Which of the following would not be described as a connected stakeholders? Customers, yes, they're connected. Suppliers, yes, they're connected. Employees, no, they come to the organization every day. They are internal shareholders, they're connected. So the answer is C, and that is employees. Now let us come to what primary and secondary stakeholders are. This is very easy. So the internal stakeholders and the connected stakeholders come under primary stakeholders, and the external stakeholders come under secondary. Secondary are somebody who are like completely not related. So that would say that external stakeholders are secondary stakeholders. This is a different method of categorizing stakeholders, which is based on whether or not they have a contractual relationship with the organization. Primary stakeholders are those that have a contractual relationship, for instance, employees, directors, shareholders. In fact, any shareholder who falls into the connected or internal categories which are examined above. Secondary stakeholders are parties that have an interest in the organization but have no contractual link, such as the public. Any stakeholders in the external category would fall into the group. So, if somebody signs the contract or they have a contractual relationship with the organization, they are primary stakeholders, and somebody who is influenced by the decisions made by the organization, but they do not have a contractual relationship with the organization, then that is secondary stakeholders. We are coming to the last and the most important topic of the chapter, which is known as stakeholders conflict. An organization can have many different stakeholders, all with different needs. Inevitably, these needs of some stakeholders will come into conflict with the needs of others. Some of the most common conflicts include stakeholder. So, employees versus managers. What can the employees versus managers conflict be? Employees would want jobs and wages, while the managers would want bonus. Customers versus shareholders. Customers want product quality, value for money, and shareholders would want dividends or profits. General public versus shareholders. General public would want that nothing should happen to the environment, while the shareholders would just want to have profits or dividends. Managers would want growth versus the shareholders would want dividends, or they would want some independence. How could a conflict arise between shareholders and bankers? So, shareholders would want dividends, they would want to take more risks, they would want to take more risks so that they would get more profits, whereas the banks, they always focus on having safety, they focus on having low risk. They would not like to have high risk, banks would want low risks. In the event of conflict, an organization will need to decide which stakeholders' needs are more important. This will commonly be the most dominant stakeholders. In other words, the one with the most power. And then, if an organization is having difficulty deciding who is the dominant stakeholder, they can use Mendelow's power interest matrix. Now, let us see what the Mendelow's power interest matrix is. It's very easy. So, there is an x axis and there is a y axis. Y axis is the level of power, x axis is the level of interest, and in the level of interest, it's low high, and in the level of power, it is the opposite, which is high low. Now you just have to learn this diagram. It is very easy. To begin with the upper one, let's begin with the first block. So level of interest is also low and the power is also low, so that is the minimal effort. Now when we come to this, level of interest is also high and the level of power is also high, so obviously they are the most dominant, they're the key players. Now if the level of power is high but the interest is low, so but then they have power. For example, government has lot of power but they might not have interest, so you need to keep them satisfied. Next we have the level of interest is high but the level of power is low. So power is low but the interest is high, so we have to keep them informed about whatever decisions we are taking. It's that simple. It might look a bit confusing right now, but if you keep rewatch the video, rewatch this section, and draw this Mendelow's power interest matrix in your notebook, and it'll be clear after solving some questions. By plotting each stakeholder according to the power they have over the organization and the interest they have in a particular decision, the dominant stakeholder, the key players, can be identified. The needs of the key players must be considered during the formulation and evaluation of new strategies. Although the other stakeholders may be fairly passive, the managers must be aware that stakeholder groups can emerge and move from quadrant to quadrant as a result of specific events, so changing in their positions in the matrix. So the stakeholders can keep changing their interests and their power by shifting in the matrix as well. Sources of stakeholder power. Sources of stakeholder power include hierarchy, provides people or groups with formal power over others. Influence may arise from personal quality, leadership. Control of the environment. Knowledge, contact, and influence of the environment can be a source of power if they are able to reduce the uncertainty experienced by others. So in reality, it must be noted that the managers, they must consider the views and opinions and needs of all the stakeholders. This means that every decision becomes a compromise. A business will have to earn a satisfactory return for its shareholders while paying reasonable wages. Coming to the test your understanding for, try to do it by yourself and then you can check it with me. Chop Limited is a forestry business which leases several large woodlands from the central government of country Z. It currently employs 2,000 members of staff across the country. Chop supplies over 300 small businesses with wood across country Z. However, recently its profitability has been poor and it has been struggling to pay any dividends. This has angered the company's three shareholders, who each own around 20% of Chop's share capital. The remainder is owned by the public, with no one investor owning more than 1% of the total share capital. The three main shareholders have asked board of directors to consider making 200 employees redundant. The employees are not heavily unionized. Now, let us try to solve this. I'm giving you 2 minutes. Make the Mendelow's matrix as much as you have understood. Okay, so what are jobs customers? So first let us say who are the key players in this case. Who are the key players who have the highest interest and highest power? It is the shareholders only. We have seen in the question. So the major shareholders are the key players. The board will see the three major shareholders as having high power due to their high proportion of voting rights. They are clearly highly interested in their investments as well. So key players are the major shareholders. Coming to the government of country Z, so I have also explained in the beginning that governments have high power but they have zero interest, so they have to be satisfied, so they are kept satisfied. Now we have the jobs customers. What are jobs customers? Where do the jobs customers come? So if you see the Mendelow's matrix, the customers in this conflict, the customers have zero interest and they have zero power in this particular situation or the conflict. So obviously they are having minimal effort. And then the last one which is left is the employees, and the employees are nothing but keep informed. So the employees are not heavily unionized, so they have very little collective power. As they are not unionized, they do not have power, but then they do have interest because their jobs are at a risk. So then the employees are keep informed. Moving on to the chapter summary, we have stakeholders, internal, employees and directors, connected and external, conflicts. We know what the conflicts are. Let's go to the practice questions. So, test your understanding 5. Which of the following would be classified as an internal stakeholder? Shareholder is a connected one, customer is a connected one, director is an internal one, finance is an connected one. So the answer is C, directors. Test your understanding 6. There are a number of different ways of classifying stakeholders, including internal, connected, primary, secondary. Which two of the above categories would suppliers fall into? Suppliers are connected stakeholders because they have dealings, and connected stakeholders are also known as the primary stakeholders. So 2 and 3 is the answer, which is C, that is 2 and 3. Test your understanding 7. A PLC. What was PLC? Public Limited Company. A PLC has a large number of shareholders. The largest is H, a pension company. H owns 35% of A's share capital. None of the other shareholders owns more than 10% of the share capital. H has been stated that it is happy with A's strategy and dividends and has no intention of intervening in A. If A prepares Mendelow's matrix, which quadrant would H fall into? Okay, so where would H fall into? It is gonna be, H has high power due to its large number of shares, we know that, but they said they have low interest in running of A. So A's director should directors should work to keep H from taking an active interest in the future. So the answer is, what did we say again? Interest is low, but power is high. Interest is low, but the power is very high. So that is C, keep satisfied. A stakeholder has a high level of interest but has little influence over the organization. Okay, visualize the chart again. High level of interest. High level of interest but low power. Low power. What is that? It is keep informed. Let us read the question again. High level of interest but has no power, so we have to inform them. Keep informed. C. Consider the following statements regarding stakeholders. Managers only need to consider those stakeholders who are key players on Mendelow's matrix. Um, Employees and managers are both internal stakeholders, meaning that they have same objective. 2 is false. And what and 9. So the Mendelow's matrix shows the key players, but then the managers need to consider everybody's opinions, everybody's needs. So 1 is false, and the second one is also false because different stakeholders have different views. So the answer is D, neither. That is it. We come to the end of the lesson. Let us just see a quick recap over what all we've learned so far. So we learned what are stakeholders, anybody who has an interest or influence in the organization. Different stakeholders have different needs. There are internal stakeholders, connected stakeholders, and external stakeholders. Primary stakeholders include internal and connected, secondary include external. And we know that when there is a stakeholder conflict, then Mendelow's power interest matrix is taken into consideration. The x-axis has the interest, which is low high, and the y-axis has the opposite high low power. And this is what is Mendelow. That's it. We're done with the chapter. I hope you understood the chapter. Just read the chapter again from your book and it'll be clear. In the further videos, we will be doing the study kit, the test kit of the chapters as well. So after this, we are going to do the chapter number 8, I guess. So we're following a certain sequence which makes sense, which is going to be easier for you to understand. So I'll be linking down the playlist of the ACCA F1 paper course below in the description box. So please do check it out. And if you have any questions, any doubts, or any suggestions, please feel free to drop them down in the comments below. Okay, thank you.